Hi, Shae Russell here, editor of the Daily Reckoning Australia. And I just wanted to have a quick chat today about how the soundness of the Aussie banking system is going to be challenged over the next 12 months. Now, the Royal Banking Commission has finally started to pick up some global attention thanks to an article Bloomberg wrote yesterday. Now, the reason why it's getting some global attention is very much because of the outside interest to our banking system. Now, Australian banks are some of the most profitable in the world. As it turns out, it's probably because they're just a little bit dodgy. As Bloomberg pointed out yesterday, though, somewhere between 1/5 to 1/4 of all of the big four bank shares are actually held offshore. So fund managers, for example, like BlackRock and Vanguard have a stake in our big four banks, as do a Japanese pension fund and Norway's sovereign wealth fund. Now, because our banks are so profitable and pay a high yielding dividend, it does make sense that these companies would be interested in them. However, in the wake of the Royal Commission, it looks like the banks are going to ditch their financial advisory services, which were pretty much money spinners for the banks. Now, by getting rid of these, there's a good chance that the offshore interest in our big banks is going to diminish somewhat, and they're likely to sell their stake in the banks over the coming 12 months. That will push share prices down. And also, too, if we see share prices falling, it'll sort of have a flow-on effect that we see the big end of town losing their interest in it. We're likely to see the small, mum and dad investors losing interest in the banks as well. Now, it's sort of a double-edged sword here, though. So if the banks are selling off the financial advisory service, it means they're losing a key part of their profitability. Now, this is a big issue because collectively the banks hold $750 billion in offshore debt. Now, offshore debt isn't a big deal when the good times are rolling. You can just roll the debt over to a new term, so it doesn't matter. The problem that we've got now is that the RBA isn't raising rates, but international central banks are, which means that offshore funding costs for Aussie banks are actually increasing. Now, by selling off their, money spinning advisory services, they're running out of they're going to lose that buffer, that way of hiding those extra costs, which means they're very much going to need to pass those additional offshore funding costs on to customers. The problem we've got is Aussie consumers are a little tapped out when it comes to credit. I think last time I checked, there's something like $2.6 trillion in outstanding debt in Aussie households. So I suspect what we're going to see is not only a diminishing interest in banks from offshore funds and sovereign wealth funds, for example, but from people, and that'll be because of their reduced profitability. However, as the bank's profitability is reduced, it will put some pressure on them in meeting this $750 debt obligation that they hold. I actually believe that there is a very big chance that this $750 billion is part of a $10 trillion problem that I've been working on for the past couple of months. I'll have a report out in the next few weeks, so make sure you keep your eye open for that. But what my analysis is leading me to think that the Aussie banking system, the very pillar of the Australian economy, the same banking system that has defied the past two financial crises and major economic downturns around the world, might not have have it in the coffers to survive the next crisis. And I do believe this could eventually be a catastrophic problem for the Aussie economy. Obviously, if you want to know more, make sure you subscribe to the Daily Reckoning Australia. And I'll be back next week with another video. Thanks, and I'll see you later.